Welcome back to another episode of What's on Your Mind. I've got ITPM senior trading mentors Chris Cathey and Anthony Iser joining me today. Gents, it's great to have you both back on the show again. I'm looking forward to hearing what you both have to say about the financial markets. But let's get straight into it. Anthony, what have you been looking at over the last few weeks?
Chris, thank you. And hello, Chris.
Hello, man, George.
Yeah, very well, thank you. Idea generation is one of the key facets that the Institute works on with our mentees. And I've been working on this heavily with 3 or 4 people at the moment. And one of the ideas we've come up with is in the utility sector, which can be a little bit boring. And normally in a market that's been strong like the S&P has this year, you would expect it to lag. But the utility sector has actually performed in line, and the company we're looking at here, Next Era Energy, has outperformed the market, and it's been a very strong performer for quite a while now. So we're looking to continue to buy this company. And for those that don't know it, it's the largest utility company, one of the largest utility companies in the world, largest generator of power in Florida. The comps, some of the names you may have heard: Duke Energy, American Electric Power, and Pacific Power and Electric. It's got 2 main businesses, and when we're working through the idea generation, we want to try and obviously determine what the company does, where it gets its earnings from, can it continue the growth for a company like this. And once we've gone through that work with this company, we realise they've got some really good opportunities ahead. So as I said, it's 2 main businesses: FPL, which is a power generation in Florida, oil, gas, nuclear, solar, mostly clean energy, which is obviously more than flavour of the month. It's flavour of the year and flavour of the next couple of decades. And then Near is its other part, which is, and that division is the US's largest generation of renewable energy. So this company on numbers stacks up quite well. It's trading on 27 times this year's earnings, 25 the year after. The sector's at 20 and 21, so it's trading. Trading slightly above the sector, but not in a massively aggressive way. The 10-year return has been huge, 17% per annum in terms of the share price. The EPS is compounded at 7% per annum over that period, and we're looking for 9% going forward. And utilities are regulated assets. What happens is they announce how much they intend to spend in terms of capital over the coming years, and then the regulator allows them to generate a return on that. And the return on equity that Next Era gets is 9%, which is very high. And we were curious about why they're getting such a high return. And it's basically because they're outrageously good operators. They are the most cost competitive providers in the market. So to give you an idea, if you were dealing with them, their average bill in Florida is just under $80 a month versus $115 as the average, and about $142 as an average power bill across the US. So what they're doing is they're delivering to consumers, and the regulator is saying, well, if you can deliver prices like that, we'll allow you to generate superior returns. So that's why we're quite confident that they're going to continue to do this. And the opportunities in the short term and the long term to surprise on the upside are pretty strong. They recently bought Gulf Power, middle of 2018. It was a $6.5 billion acquisition. They've announced plans to cut operating costs by 50%. So that's how much they feel that they can operate generation companies, power generation companies and assets better than their competitors, that they can buy an asset and reduce the cost by 50%. They'll also cut the customer's power cost by 20%. So then obviously the regulators and the governments are very happy, and they're reducing carbon emissions by 40% as well. So it looked really interesting. We would be continuing to buy it. It's popped up on our radar. here at the Institute. And yeah, its power is generally pretty boring and pretty safe and steady. It's been in the news a little bit because of the wildfires in California. And you will have noticed PG&E, which is possible short on the other side if you were looking for something. It's probably going to go bankrupt because of the wildfires that it's caused over the last couple of years. They look like they're going to settle on the ones from 2017, but they've got the massive ones in 2018. And if you've watched the news at all recently, you will have seen they've cut power regularly to millions of people in California to avoid more fires there. So there's a short on the other side for you if you want to find an intra-sector spread. But next year, just as an outright long, continues to look very, very good.
Interesting stuff. Chris, what about on your side? What have you been looking at?
Well, first of all, I think Anthony's idea that sounds fantastic. Really, really compelling. I agree that with the S&P's all-time high, great. Okay, everybody kind of knows that. The whole fears recession seem to have been receding at the moment, so the world is like sort of moving on. But I agree completely with Anthony. This is for the Institute here. This is a fantastic stock picking market. Idea generation is absolutely key to generating returns, and the environment we're in right here, right now, with negative interest rates, is just fantastic to generate long short ideas. Now, again, within the intra-sector, a couple of trades that I've got on, and I've been looking to increase them. Copart against Ford. Copart is an online vehicle auction company. It has a patented virtual auction technology, so it's got the IP behind their business. Currently operating in the US, Canada, and the UK, and expanding into Germany, Spain, Ireland, Finland, and Brazil over this year and the next year. The business works basically that the car manufacturers have kind of killed themselves almost, that cars now are more reliable and last longer than they ever have done before. So there is a real market for used cars, and especially those which are deemed to be economically unviable to repair from insurance companies. So typically the insurance companies are the supply of the vehicles, and the buyers are generally the sort of any dealers or builders or just the general public. So it's a fantastic business. Over the last 5 years, the EPS has been growing by about 20%, and that's focused to continue. P of 32 versus the sector, so it's at a slight premium, but that reflects the quality of the business and the quality of their growth and the forecast going forward. Now, against that, I mentioned the sort of car manufacturers. Ford been a great short this year, so just short of 10%, versus the S&P's up 24%. So this trade so far has picked up around about 65% this year. Copart against Ford. Look to continue the trade. Look to increase it basically any weakness, or even just to sort of follow the trend. But Ford, middle of October, cut revenue guidance from around about 7.5 billion to around about 6.5 to 7 billion. So that was roughly about a month ago. And they've just announced that they are going to invest just about $11.5 billion over the next 3 years to make a hybrid version, electric version of the Ford Mustang. This just seems to me that this is a defunct, broken business model. The 11.5 billion investment over 3 years, when they've got revenue, they've just cut revenue guidance to around about 7 billion. So it's roughly around about 150% of their revenues. It's got a debt to equity ratio of just short of 3. So trading at a PE of 7. So clearly this is a low value stock, but it's a dying business model. And I would not be surprised to see Ford and other car manufacturers maybe going into bankruptcy over the next few years. So yeah, I like the Copart against Ford. It's a trade that's been working, and I will continue to do so, in my opinion. Back to you, mate. Any more ideas?
Before you jump in, Anthony, actually, I had a quick question about that idea, Chris. We've spoken before about the kind of explosion that we've seen in car financing, right? And it kind of seems to me that potentially that trade also suits the possibility, if there was one, of some liquidity issues for car financing. So I think people like car manufacturers like Ford maybe combating shooting themselves in the foot with extra reliability by offering financing and getting everyone new cars all the time on a rolling basis. But perhaps Copart would benefit better if there was any liquidity issues. This trade could work out even better for them, right?
I totally agree. I think the PPI, whatever it's called, the car manufacturing, the finance deals that we've seen over the last few years. It seems to me that this is potentially the next PPI. We have the personal pension, private insurance scheme in the UK, which has been basically refinanced. It's been rolled back over the last 3-4 years to the general public for mis-selling of pension and insurance products by the financial institutions, mainly the high street banks. My view is on the car finance deals that this is potentially the next PPI scandal to hit the UK and the rest of the world. So yes, clearly very negative for the car manufacturers, but a huge positive for Copart because you've got continued ongoing supply. So more revenue for Copart and a potential huge negative for the car manufacturers.
Yeah,
totally agree with you.
And you're right that it's well worthy of investigation. But even just from a personal point of view, for any of our listeners out there, you really don't want to go and finance an asset that depreciates 20% as soon as you drive it off the lot and keeps depreciating. The leverage that we like to use at the Institute hearing is on assets that are going up. So save your leverage for your portfolio and forget about it for furniture, for cars, and anything else that is going to be guaranteed depreciating asset.
I tell you what, it's totally crazy. It's crazy that there's so much finance available, but I guess it's the only way that the car manufacturers can shift cars.
Exactly. To your point of why the business model's broken.
Totally, it's a broken business model.
So that said, I'm actually going to buy a stock in a broken business model. So pay TV, and I can hear everyone out there already saying, hang on, Disney, Netflix, Amazon TV, everyone is going to destroy pay TV. And you're right, they will. But Cable One, which is one of the leading broadband companies, cable companies in the US, 7th largest provider across 21 states, it has performed incredibly well. Its PE is 47. So it's pretty punchy. The sector's on 30, but we've got 15% EPS growth for the next couple of years. The stock has continued to do very well. So we're very happy to keep buying this one at the moment. The Q3 results came out. Revenues for the sectors, for the divisions we like, up 30%. Net income was up 30%. EBITDA margins up 340 bips to 49.1%. So if you're in the US, the brands, they operate a New Wave and Sparklight, and they've just recently acquired Fidelity Communications for about $500 million cash. They're hugely cash generative, but their TV revenues are down 5%. So how's a cable company doing this? And ultimately, they saw the writing on the wall and have been transitioning away from pay TV. The way the pay TV business model has worked for the last decade or two has been bundling. You would have your phone bill and then you eventually bundle in your pay TV and you get 200 worthless channels that cost about 5 cents each because you wanted to get Fox Entertainment and ESPN Sports, which probably cost you $10 or $15 each, and they'd bundle it all into one thing and say, here's your bill for $110 a month. As we know, everyone has switched to the streaming products. So Cable One, every time you call up them and say, look, I don't need my pay TV anymore, they say, no problem. But because you're streaming, how about we just boost up your broadband connection and give you 2 gigabytes per second instead of the 500 megabits you're on. And then you'll be able to have no issues when you're streaming Netflix or Amazon Prime. And everyone is saying, yep, okay, that sounds good. And this is massively high margin business. They're ditching the old pay TV stuff. And so it's going slowly out the door and it'll eventually be gone altogether. So they've been very much at the forefront of this. They haven't got a lot of competition. So I'm being slightly obtuse because they're less of a pay TV company and more of a broadband company now. But that was their traditional business, and you must give management credit for not only recognizing this was coming, I think lots of people have, but coming up with a strategy and executing on it that has allowed stellar growth and continued growth in what's been in a tough market. So again, because it's a stock picking market at the moment for us, we would look at something inter-sector potentially as well. So Dish TV is the company that hasn't made the transition. It's showing no signs of doing it at the moment. Earnings are down 20 or 30% for the next couple of years. If they do come out and say they're going to start doing that, fine, we can look at that position then. But until they do that, this is just a dead company in a dead industry, and it's sort of worst of the worst. So there's the short. Cable One continues to be something that we'll look to add to it even at these prices.
That sounds like a great idea, mate. I must admit, I like the we talked about sort of stock picking, and you talked about the valuation there. But the reason why a company like that would be at a premium is because clearly it's got a very high quality management. It's exactly what you want to look for.
Yeah, the lady running it, her name escapes me at the moment, but she's done a cracking job. Not just executing and not coming up with the plan and executing it, but informing the market and managing expectations on what they're doing. And they've done a really good job, Chris.
Sounds great.
I think it's interesting as well, for our viewers to hear a long idea come out of what is essentially consolidating a business model as opposed to pure top line growth as well. So good to hear something that's a bit different as well. Chris, let's go back to you then. Have you got any more ideas to share with us today?
Yeah, just a long, short idea which I've got on, and a couple of my guys have got on, and it's picked up around about 50% this year, 50. It's Equity Lifestyle Properties, ELS, against Schlumberger Oil Services business. So it's a ELS, Equity Lifestyle, is a real estate investment trust. Operates and manages manufactured housing and recreational vehicle parks in the US, and it's very geared towards the retiring market. So this is very much a play on the US and the Western world, but it is focused in the US on an aging population, and how they're going to live out their sort of twilight years. It's high end of the market. It's the aging population is creating demand. This company has had a roughly around about 9 to 10% EPS growth since 2014. It's forecast for around similar sort of numbers for the next 5 years. It's on a slightly less dividend yield than the sector. The sector is around about 3%. This is around about 2%. But the big difference to the sector, the debt to equity ratio across the real estate investment trust in the US is around about 50. So very highly leveraged companies. This company's got virtually no debt. It's all self-financing, which is clearly lowers the risk. And even with that, with a less dividend yield and much less debt equity ratio, it's still in line with the sector in terms of valuation. So this is a highly profitable, very well managed business. And the demographic trends in the US with an aging population are going to continue to make this grow. So yeah, ELS, Equity Lifestyle Properties. And again, it's Schlumberger. Again, sort of, as we've been talking about, this is a stock pickers market. Year to date, Schlumberger is down about 6%. So it's underperformed the S&P by around about 30%. Oil services business based out of Texas. And just go back to basics of what the Institute is about and how to generate ideas. This is straightforward at the numbers. It's got EPS slowed down around about 10% forecast for the full year 2018-2019. It's highly geared to the oil price because it's an oil services business. And just want to flag, it's got a PEG ratio of around about 3.5. Highly expensive. Anything goes wrong, any wobbles in this business, and this company is extremely expensive. So it's underperformed the market, it's underperformed the sector. But I just wanted to flag this is a valuation play. This is all about how the Institute generates ideas. Look at the numbers, look at the P relative to the sector, look at the earnings relative to the sector, and this is how you generate long short ideas. So yeah, ELS against SLB, Equity Lifestyle Properties against Schlumberger. Trade that's been working great this year, and I continue to work for the next few years. I think this is a few years easy trade for the next few years.
Yeah, I was just going to ask that actually. I was just going to say, because it's a sort of demographic trends that you're looking at, this is potentially a longer term play on the ELS side.
Absolutely.
Cool, guys. Well, it's great to hear some more ideas from both of you. I'm sure our audience appreciate it. I know I certainly do. And speaking of our audience, actually, if you guys are looking to learn more about trading and portfolio management, you're enjoying the content that you see here, then you can find more information on our website, itpm.com. And certainly if you check out our video courses, we'll teach you how to trade equities, currencies, options. There's courses for all of those. And if you're not quite ready for those courses, then we've got other resources available, such as our events like our online webinars and our live seminars that we do around the world as well. But anyway, that's all we have for today. I hope you guys enjoyed the show, and make sure you catch us next time for another episode of What's on Your Mind.